Private equity invariably supports quite well-established businesses which have demonstrated profit and demonstrated a market, but are looking for some sort of gear shift in terms of what they think they can achieve. So this is really about scaling up a quite well-established business proposition, either by, for example, if it's in the retail or restaurant sector, expanding the number of outlets, or perhaps by creating a much larger export dimension to what the company is currently doing. Generally speaking, a private equity buyout would involve close to or absolute controlling stake in a company, normally alongside a management team. So the management team might own a third of the business, private equity might own half the business, and there might be some other actors involved in the remainder. So it's a much more substantial commitment in terms of ownership than other models. A very large proportion of private equity business transactions come from founders or family-owned firms who've made a success of a business, think they've done what they can with it, and are looking to either find a new partner or hand it on in a sort of condition where somebody with deeper pockets can help assist the growth of that business to another level. Well, I think the advantage of private equity ownership is that you're not subject to the endless scrutiny of quarterly results in the fashion that you are inevitably if you're on the stock exchange. So there is, if you like, there's more time and more space in which to develop a business plan, which particularly if you want to engender quite substantial change in a business, particularly rapid expansion, that may feel a relatively safe harbour in which to do so. The downside is you don't have that form of sort of permanent funding, I suppose, of a sort in which the stock market listing offers you. It's a different sort of business proposition, but they're not incompatible. The level of private equity investment obviously varies according to the size of the business. I mean, 85% of private equity investment is actually in what's technically SME businesses, those with 250 employees or less. So you're probably therefore looking at sort of check sizes of perhaps 10 million up to 50 million, depending on precisely the nature of the business and the agreed valuation. Now, at the very largest end, obviously you could be talking about hundreds of millions and billions, but that's very much the exception rather than the rule. Yeah, a typical private equity investment would last between 4 and 6 years. It depends on the nature of the sector, and it depends obviously on the nature of the economy, and it depends on what's best in terms of timing for the company to sell. During that time, there'd be very active management, there'd be board seat management involved in the business as well. Generally speaking, when an exit comes, there are three forms. There's either a trade sale, there might be a sale to another institutional investor, or there might be a stock market listing of some form.